Ali and Julian once again with an episode of Personal Finance Boss. And as you can see, we are in our new location. If you're watching on YouTube,
well,
thanks.
We're actually filming it. We're filming it again.
Okay. We're filming it again in a new location.
Because I was too lazy to sync the audio with the video.
Ah, I see.
But now I got a mic that I'm hooking up on my camera, so hopefully the sound's going to be okay. This is like a first test, so I'll see if it works well, and if it does, then I'll post the video on it with the mic audio. Otherwise, I'll have to sync the audio.
Nice.
Proceed.
Very tech savvy.
Sure.
That's why in charge CTO of Personal Finance Boss.
Sure.
Not that it means much. But today we're back with another topic, and today we're going to be talking about real estate investment trusts, or simply to break them down, REITs or RITs. I still don't know what the correct pronunciation is.
REIT,
but real estate investment trusts, very interesting investment vehicle, a little bit different than a traditional stock, still traded on an exchange, could be part of an ETF portfolio also, if any of you are wondering, or a mutual fund. But yes, they are a different investment tool. And why is that, Julian?
Well, they invest in real estate, if the name didn't give it away already.
Mm-hmm.
So basically what there are different types of REITs, but we'll just start with like the core concept is it's a pool of investors, so kind of like a mutual fund or an ETF, right? And with that pool of money, you then invest in real estate.
Okay.
So if you have...
Is it any kind of real estate, or...?
It could be any kind of real estate, but normally it's
commercial.
It's different sectors. So you can have residential REITs, you can have like healthcare, you can have commercial, you can have like just like how ETFs, you can have like healthcare ETFs, growth ETFs, defensive, whatever. Same thing with the REITs. You have different type of real estate, right? Okay. And you can have equity REITs, which means that you buy the property and you make your income by collecting rent checks.
Okay.
And you have the mortgage REITs, where you actually loan out the money to the people buying the homes, and then you make the profit in the
mortgage interest
interest margin spread, interest margin, whatever. So if the interest rate on the mortgage is 5% and the prime is like whatever the benchmark
let's say
lending rate is 3, then you make 2%, right?
Okay.
Or minus maybe some fee for this, the managing, whatever.
And if I'm correct, equity REITs are more common than mortgage REITs.
I honestly don't know which one is more common.
Because I don't think I've ever invested in a mortgage REIT.
Yeah, if you say that they're more common, then they probably are, and I think they would be more common. Mortgage REITs, they sound a lot like CDOs and stuff like that.
Yeah.
So collateralized debt obligations and commercial mortgage-backed securities and stuff like that. So you invest in pools of mortgages. So it's similar in that sense. But in this case, we're only going to focus on the REITs. We can also do an episode on all these commercially backed securities. But then again, it's less available to the retail investor. And since the point of this podcast is to really focus on the individual and not the institution.
Hence, Personal Finance Boss.
Exactly. Not your finance bachelor degree. So it's not super relevant. But since REITs can be purchased on the stock exchange in the form of an ETF pretty much, or just like you would purchase an ETF, then it's fine. So what would you like to say about REITs, Ali?
Well, a lot of people nowadays, they're always talking about real estate investing. And so let's talk about real estate investing in general.
Sure.
So the pros and cons, obviously the pros are, everyone says that real estate and land is a commodity because Mother Nature is not producing any more land, and hence land will always continuously go up in value. And
SpaceX.
Yeah, okay, SpaceX, fine. They're going to another area, but that's still a little bit far away.
It's been a forever argument towards raising prices in real estate.
And based on what's happening with Tesla right now, how Musk is pulling off money, pulling off like engineers to do the programming to like actually make cars, and how all that.
That was more of a joke, but it also doesn't account for like a mass epidemic.
Yeah, but
because if half the population of the planet was wiped out, whatever, then real estate wouldn't hold its value
of course.
Anymore. So there are scenarios where real estate would lose its value, like a world war and stuff like that.
Yes, for sure. But there's also a case like there's just limited land in those high density areas. Like Canada, we have so much land, but no one wants to live in like northern Quebec all the way up top there. Like there's so much land there, but no one wants to live there. We all want to live in those metropolitan GTA areas.
But then the issue with purchasing real estate is it's expensive. So
Yes.
if you want to purchase a duplex or a triplex or whatever,
or even a piece of land,
you need to have 20 to 25% down payment.
correct?
So if you're buying let's say a $1 million sixplex, you need $200,000 to $250,000 in down
Minimum. Yeah.
You then need to get approved for the mortgage,
Yes.
so you need to have sufficient income to make the bank happy. Even though you're renting out the whole thing and it pays for itself, you still need to get the mortgage. And one way to do that is to pull investors together.
Yes.
But that's a lot of work. You
Yes.
to find friends, family. Do they trust you? Do you really want to risk your family and friends' money? Have you ever done this before? There's a lot of risk when you purchase an individual unit of real estate. You can have the bad foundation. You can have termites. You can have mold, whatever.
Yeah. Or tenants
plumbing.
that just leave. Also,
Yeah, tenants leave. They don't pay. Plumbing, bursts. All these things, all these problems that then chew into your profits. And then there's vacancies. So just not being able to rent out the units. So if you buy one condo, for example, and you don't rent it out, you are 100% vacant, meaning you make $0.
Yes.
If you own 100 doors, so 100 units, or like 6 apartment buildings with 20 units each or whatever, then if you have one unit that's vacant, it's not as much impactful. But to get to that point, you need a lot of money, a lot of contact, or good luck. So
very good luck.
My cats are going to play with the cat.
It's okay. They're having fun. But yeah, that's the argument. And that's why we wanted to talk about REITs, because REITs allow individual investors with not too much equity to kind of get a little bit of taste.
With zero equity, because if one unit of the ETF say is like $20,
that's all you need to get exposure to the real estate environment, and you'll get a profit. The good thing with REITs is that they're legally obliged to actually distribute 90% of the profits as dividends. So that's why the yields on REITs are really high, and we've always said not to chase yields, but REITs are a different
it's a different type of investment.
It's a different investment.
Because it's invested in real estate, but since it's traded on the stock market, the correlation between the stock market, and the REIT is going to be higher than, say, an actual sixplex or a mall, because it's traded on the stock market. So if the stock goes down, then people, they just sell, they just lighten up their portfolio for the down, the bear market or whatever. So the correlation between stocks and the REIT is going to be higher. So you're not like 100% invested in real estate. Maybe like 60% exposure, because you're still exposed to the movements in the stock market.
And REITs can actually hold some money that they have in cash and equities. They're actually allowed to do that. But most of the time, their money is held in different properties. And that's why in cities that have public house assessments, you could actually look at like some of the big shopping complexes and you'll see that those are actually owned by REITs.
Yeah.
So, for example, in Canada, all the Walmarts, or majority of the Walmarts, are owned by a REIT called Smart Centers.
Okay.
And this was actually a guy in the 80s who convinced Walmart to open their first property here and to open it on his property. And ever since, he's been balling because they've been renting space from him. And that's another thing with REITs. If you have more properties and in better areas, they're going to have better chances to get tenants and keep those tenants over a long period of time.
And kind of similar to REITs, you mentioned, like Smart Centers, that's a REIT, but you can also have a company called, Smart Centers, but that actually owns the properties.
Yes.
And that's a group of investors, maybe 10 investors.
Yeah.
Because you need a minimum of 100 investors for it to be considered a REIT.
Okay.
If you have 10 investors, then you can create whatever the most beneficial legal entity is to then purchase several, commercial properties, and then you could rent those out to Walmart. So that's also another way to do it.
Yes.
You can have like a holding company that would then hold the real estate, and then you would make money that way. But I would guess it's on a smaller scale unless you're with very, very wealthy people.
Well, very, very wealthy.
Yeah.
It's very, very costly real estate, and especially now, after 2008, they're kind of becoming a lot more stringent on their testing and the stress testing now in Canada. I don't know about the States, but in Canada, they're testing you at your income level 2% above the prime rate.
2% above your actual mortgage rate.
2% above the actual mortgage. So if I'm getting a mortgage at 3%, they're going to test if I can make payments at 5% actually.
Yeah.
Which is a big jump. It's only 2%, but it actually represents a very big chunk of money going out every
it does
month.
make a difference. It definitely does. But I guess that's good for a real estate investment trust that invests in mortgages because the default rates are going to be lower, and especially in a raising rate environment, it's nice to know that the new mortgages are going to be more solid. If you have a 7-year-old mortgage, then it was probably super easy for them to get. But at the same time, that's the way it works, and we're slowly adapting to the new market. Also, when rates go up, if a rate is invested in mortgages only, then they can suffer from profit erosion because rates go up, so they make less money.
Now, we talked about different sectors. Like, I know REITs, they have like a REIT that's just like an apartment REIT. Then there's like a shopping complex REIT. Then there's like a retirement residence REIT, and then like a hospital REIT. Would there be like a specific type in that bunch that you would zone in on as an investor? Like, let's say we're focusing on growth or we're focusing on safety. Is there one over the other that you'd focus on?
That's a good question. I mean,
well, that's why I asked it, right?
Yeah, okay.
We're about asking good questions on personal finance.
To people that have no idea what to say.
No, but I'm just
say anything.
No, but what would you? Well, I mean, you're not biased towards ETF, but you like ETFs.
Yeah.
So, what would you, if you said, like, Julian, here's $1,000, it's only allowed for REITs.
Yeah.
Is there an area that you'd be more prone to kind of investing in, or does it not matter?
Well, first off, you need to come up with an investment thesis. If you're saying, okay, like the baby boomers are retiring, they're going into retirement homes, stuff like that, then you can say, okay, well, looking at something in this healthcare / retirement home, find a REIT like that. But then again, real estate is here to stay, to my knowledge, and
unless
real
we
estate,
get SpaceX.
I don't know about people who would want to terraform Mars, but
you wouldn't fly to Mars, right? I think we've had this. If
why
you wouldn't
why
like
would
just to go
Mars?
see him, see what's up, or something?
Isn't it a super long trip?
Yeah.
Okay. Well,
but
no,
you wouldn't. Okay.
I don't have the money anyway. So.
But let's say you had the money. Let's say you invested in REITs and became super rich, and then you were able to buy the.
Investing in REITs won't make you super rich. It's mostly for the income that people invest in it. So like 8% dividend. Make that a year. It's a good income. It's foreseeable, unless the actual value of the stock goes down. But otherwise, it's pretty stable.
But you wouldn't travel to Mars.
No, I wouldn't. I mean, if it took 3 weeks, maybe. If I'm feeling a bit adventurous, but otherwise, I don't see the purpose of traveling to Mars.
Okay.
Yeah, so I would try to come up with investment theses. Anyways, to try and figure out, okay, what would be the best place for me to put, my money in real estate. But like, I wouldn't go in commercial. I wouldn't go in malls.
Like Walmart-esque type things? Like shopping malls,
shopping
outlet
malls.
malls?
I wouldn't do that in North America. Maybe like in Asia is a whole other beast for some reason.
Is that because retail is going down here?
Yeah. Well,
and Amazon is...
Yes.
Okay.
I would buy a REIT in Amazon.
Okay. you'd buy Amazon's factory and then create that as a REIT.
I would buy their stock, even though I don't own their stock, but I would buy their stock.
Okay, interesting.
Yeah. What would you do?
Well, I'm actually invested in smart centers.
Okay.
Because they're mostly Walmart, and Walmart is very safe for now, and Amazon is hitting them.
For now.
Amazon is hitting them.
But in Canada, Amazon is not as strong as in the States.
Yes. Yeah. Obvious reasons. But they're coming. But Walmart is still like recession time hits. Who was it telling me? One of my directors at work, he was telling me like he orders everything on Amazon. Like diapers are cheaper, coffee's cheaper. He set up like subscriptions on Amazon to have everything delivered on time at his house.
Okay.
And he's like, it's cheaper than Walmart. And I was like, wait, that doesn't make sense. It's like Walmart's supposed to be that was a bit. But generally,
but it's because Amazon could source their stuff from many different suppliers. Yeah. So Walmart apparently doing business with them is like the worst thing in the world.
Yes.
But
it is. It's complete. We can talk about that in another episode.
I don't know as much as you probably because you know a lot of weird stuff.
Yeah.
But But so Amazon has a lot of suppliers and the volume that they have, and you don't need to drive to go to the store, so it's super convenient.
Interesting. But yes, Walmart for now I think is safe to stay. I also invested, so that retirement residences, I've looked at them, but I've never actually kind of delved into them.
Yeah.
I am invested in a different type of company that actually owns funeral homes.
Okay.
So they own the land they own like crematoriums, they own funeral houses, they own cemeteries, which is kind of like a REIT, but not really. But like that I looked at it as like that is definitely here to stay.
Yeah.
What's
the name of that company?
It's called Parklawn.
Oh yeah.
Are you familiar?
No, but you told me about it before.
So it's that one I've looked at like here to stay, and actually it's posted in the last 5 years an 88% return in the last 5 years.
Like from times 0 to times 5, 88%?
Yes, 88%, which is absolutely, I find, insane.
So it's like 15% a
year. Which is crazy.
With compounding?
Yes, and then there was one that recently got released that was a student housing REIT.
Okay.
So they buy the residences around university areas. Yeah. So I find with those, like, you're getting into, what I like about REITs is you're getting into these little pockets of areas that I would never have access to, even in my wildest dreams. And I find that, okay, well, maybe not now. For sure not now. We'll see in the future. Yeah. But for now, like, there's no way I'm buying a whole residence.
It's hard. Sure.
What I find, though, that's becoming a lot more common and why I think REITs are gaining popularity is this huge discussion with retail about spinning their properties into REITs. And even with McDonald's, there's been, like, a lot of chatter because McDonald's, if you guys don't know, McDonald's, everyone thinks McDonald's biggest money maker is their food. It's actually their real estate.
Yeah.
Because McDonald's buys the majority of their properties that their franchises are on. So if you think about it in that perspective, like McDonald's owns intersections in like central London. They have a store in New York, in Times Square, in Hong Kong, all these major markets. And if you think about it, they could turn that into REITs and then collect the rent from their tenants.
But don't they do that with the franchisees?
They do, but imagine them selling their assets. Let's say you sell all your real estate assets to another company, and then you sign like a 50-year lease with them at a reduced rate because you're selling them this key real estate. And they've talked about that with like retail, with Sears, with Hudson's Bay.
But those guys need cash.
They need cash
as
well. They need
so.
cash as well. But if you think about it from that perspective, like the value of holding that property, even though your business may be bad, you may have some underlying strength in that property.
Yeah, for sure. You can always leverage your real estate, or like you can factor it kind of and get money for it.
Exactly.
And lease it from the person that bought it from you.
Exactly.
If you need cash today, but I don't think McDonald's is in a need.
No, they don't need that. They don't need
Sears
cash.
and Hudson Bay.
Sears needs Hudson cash, but Hudson's Bay actually sold their Fifth Avenue property to like WeWork, and then they sold it another half to like another company, and they're actually renting it from them.
Didn't Sears die?
Sears is dead in Canada.
Yeah.
Like fully dead. And in the States, it's like...
Isn't it a Canadian company?
No, it's an American.
Okay.
Yeah. But I think that Canada was run separately.
Okay.
But yeah, and like back to the retail argument, if you think about it, like commercial REITs, if like you're right on the retail side, because like Target came and they had 270 stores, I think, in Canada, and they left.
Yeah.
And now as a mall, like your main anchor is gone.
Yeah.
So which puts a huge dent in your profits and your rent.
Yeah.
For the foreseeable future, because renting that space is not hard. So it may happen that because of the rise in e-commerce and everything, that you're going to end up with huge pockets of land just sitting empty.
In the next 20 years, I don't think retail commercial space is going to be, I don't know.
What about office space? Because we're going towards a trend where kind of like shrinking offices. There's not as much people coming in. There's a lot of like working home. People are on the road.
I'm not super bullish on commercial.
Warehouses for sure, but like
Amazon's gonna take them over.
Yeah, but like what about just like plain offices?
Yeah, I'm not super bullish on that. Like honestly, I don't like, especially in Quebec.
Mm-hmm.
Especially, I don't see businesses coming here.
Yeah,
like there's no reason for a business.
The economy's doing good right now.
Yeah, economy's doing good because the economy's doing relatively good around the world. Relatively, like we'll see with NAFTA and Trump and all these tariffs and stuff. But with the French and everything, and there's a lot of vacant commercial properties anyway. And our friend, Dev, he's investing in commercial real estate, and he regrets doing commercial. He said we should have done residential right off the bat because it's easier. Like maybe the return isn't as high, but it's much easier to find a tenant for residential than commercial.
Well, for sure, the space, location,
if you find
everything.
a good commercial tenant, they're there for 15 years. You know? But pros and cons to everything.
So, do you think in the next, I don't know, let's say 3 decades, we're going to be seeing an increase in vacancies for commercial and kind of a decrease in their REITs?
If the economy keeps growing, like businesses expand, new businesses come. Then it depends on the corporate culture, I guess. If like
Okay.
you work from home, or if you go to the office. If you go to the office, then commercial is probably going to be okay. But if more and more people are working from home, so why have such big office spaces? And if you go open concept, you don't need as many offices. You don't need as much space. So, like.
Do you think then that would kind of drive down the overall real estate market across the board in terms of prices? Because usually real estate like appreciates about 2% or so every year. Do you think if we're going to see like a spike in, I don't know, big offices and big retail spaces, it's going to drive down the whole market in general?
No, I think they're going to destroy those and make condos.
Did you say destroy the ozone and make condos?
No, destroy those. Destroy salvage the properties or transform them into condos.
Okay.
What they're doing in like the hippier part of towns in Montreal is they're converting old warehouses to open office spaces, and a lot of them are renting the office spaces out on short-term leases and stuff like that.
Like
or they're making shared office spaces. That could work depending on the area, but if you're talking about on the side of a highway, the new generation, we don't. I mean, I do and you do, but we don't have cars, we don't have money. We don't own anything because everything's super expensive. The wages didn't go up, so it's a whole new generation with a whole bunch of new problems. But anyway, we're like way off topic.
Yeah, we have Macs. We all have Macs. Somehow we've all had Macs.
Yeah, because
I
bought it on Kijiji.
Yeah.
Way off topic, but so you can come up with any investment thesis you want. Like the hard truth is, I have no idea what I'm talking about. I can only
but you have more than
I can only hypothesize about what I've seen, what I would think. But there are people that.
But that's a whole point of.
But even analysts that say they know what they're talking about,
no, they don't.
They don't really.
Or they do, but they're trying. They've already invested in it and made their money, and now they're just like, yeah, we did a good job, and no, you didn't.
But real estate investment trusts are interesting. You get a nice payout, a nice dividend. And depending on how the tax is treated, dividends are treated for the tax laws, then you can also benefit from that. Anything you want to add?
No,
instead of the and the and the
I've added a lot. Okay.
Okay.
Very important contributor to the spread.
I know.
But other than that, thanks for tuning in, guys. And you can always reach us at personalfinanceboss at gmail.com or on our Facebook page at personalfinanceboss. Hence, personal, not commercial, but finance boss.
Yes, not Bachelors of Finance.
Yes, and we'll be back with another episode in the coming weeks.
Yeah, and on YouTube now, if the audio is good, then it's going to be up pretty much
I think it's going to be good, and they get to look at our pretty faces.
Yeah, but we're going to have to work on looking at the camera.
Oh yeah, it's true.
Maybe I'm going to set it up on the table, and we'll be on either side of the table looking at each other.
Oh, okay.
And the mic will be in the middle, and the camera's going to get us on the side. So maybe I'll try that.
Okay,
We'll see.
All right, thanks, guys.